Hey, what's up guys? Welcome back to the channel. Today I want to talk about the top 3 stocks that I'm watching for February of 2021. These 3 plays that I'm looking at today are either beaten down heavily or still have some room to go back to their all-time highs. Before we get into it, remember to hit that like button down below as it really helps the channel to grow. Also consider subscribing for more personal finance and stock analysis videos to come in the future. Jumping right into it, at number 1 we have Coca-Cola, ticker symbol KO. Coke has been beaten down quite heavily over the last month, dropping more than 10% from its New Year's Eve levels. The majority of this hit is attributed to the new strain of the virus, which analysts predict will slow down reopenings in many parts of the world. This would of course have a substantial impact on Coke revenues as people are unable to enjoy things like movie theaters, bars, and live sports. Although the broader market did shrug off this news, Coke is unable to bounce back and now sits at a very interesting level. With reopenings and vaccine distribution taking place in many parts of the world, Coke could prove to be a nice dip buy to anyone who is patient in the short term. Coke as a long-term investment is about as safe as you can get. With a solid dividend and an over 40% market share, the long-term projections for this company have and will continue to remain strong. Earnings are coming up for this company and it will be really interesting to see how they go. With the miss on these earnings, I see this as a very strong buy. Personally, I've gotten in now before earnings with the potential for a beat, but I'll be adding heavily with a miss on earnings. Over the past year, analysts have had a very negative opinion on Coke and have been wrong almost every time so far. Coke has constantly beat estimates, and with another very negative estimate for February, we could be in for another very pleasant surprise. Looking at Coke's balance sheet, we see that they have been very resilient even through this health situation that we have been in for almost a year now. Coke has added over $10 billion in debt since the beginning of the pandemic, but I don't see this as too big of an issue given their free cash flow and cash on hand that they have available to them. In the 9 months ending in September, where 7 of those months included the pandemic, we see that operating income is down 16%, which when we compare to industries like movie theaters and restaurants is much easier to stomach. Given that a good portion of Coke's revenue is generated from these industries, it shows that they've been able to ride out the storm, which further strengthens my bullish thesis on the stock. At number 2, we have Alibaba, ticker symbol BABA. Alibaba was beaten down heavily over the last 3 months of the year with an over 33% drop. The beatdown was a result of an antitrust investigation. This investigation was opened due to the monopolistic behavior that Alibaba has been displaying. This was a result of claims that Alibaba was not letting its vendors list their products on other retailers. Another reason for the drop was that Chinese regulators blocked Ant Group, which Alibaba owns a 33% share in, from going public because of certain requirements and disclosures that they were unable to meet. And finally, the prolonged drop remained as many people were uncertain about the health and whereabouts of Jack Ma. He did not make any public appearances for over 3 months, which led many investors to lose confidence in the business. Recently, Alibaba has been surging as Jack Ma has resurfaced and because Ant Group has restructured to become a financial institution, which will hopefully lead to an IPO in the near future. Currently, the stock up is over 25% from its lows that it saw at the end of the year, but I still believe that there's a lot of upside for this company. Although Alibaba has recovered substantially, I still see it as getting back to all-time highs and beyond in the next 6 months. It will continue to be volatile, but overall I see strong upward potential. Baba's cloud computing business has also seen record growth with a 60% year-over-year growth rate. This beats out competitors like Amazon and Microsoft, who saw 29% and 47% respectively. At number 3, we have Canadian National Railway, ticker symbol CNR.TO. CNR is one of my favorite Canadian companies. With their expansive rail system and their very strong leadership, anytime the stock dips, I see it as a strong buy. Overall, CNR is a very stable company and should be a staple in any dividend growth portfolio. This recent dip has been quite unexpected with no real news to explain the reason. CNR's earnings also came out this week and they were very solid with a beat on both revenue and earnings per share. We still have over 7% to get back to all-time highs, so I would definitely be looking to pick up a share or two. Looking at CNR's financials, we see that they have been resilient to both the pandemic and to the low demand for oil. Overall, I really like this company and the rail industry as a whole and will continue to buy only on dips. Well, those are the 3 big names that I'll be watching this month. Let me know what you're looking at in the comments down below. And remember to hit that like and subscribe button. I'll catch you guys in the next one.